Welcome back to the deep dive. Today feels, I don't know, it feels heavy, but maybe in a good way. We're looking at the state of the Canadian housing market right now. It's January 2026.
It is a big one.
And honestly, looking at this stack of research we have, I mean, government tax updates, new CMHC guidelines, banking reports, the vibe out there is just so confusing.
It is.
It feels like this weird mix of like anxiety and real opportunity. I was reading that sales were actually down a bit in December 2025, but the appetite, the number of people searching, it's surging.
It is a strange mix. You're right. The intent to buy is definitely back, and I think that's because the landscape has, well, it's fundamentally changed. If you've been sitting on the sidelines for 2 years, waiting for prices to crash or rates to drop to zero, you might have missed that the rules of the game are different.
The actual rule.
Literally, the federal regulations and the tax code.
Yes.
They're completely different today than they were in 2024.
That is our mission today. We're not just talking about how to find a nice bungalow with a backyard. We're talking about navigating the fiscal ecosystem of buying a home in Canada in 2026. Because reading through this, it seems like it's less about hoarding cash and more about stacking.
Stacking accounts, stacking strategies, and, choosing the right allies.
Right. And speaking of allies, we have a specific focus for this deep dive. We know a lot of our listeners are Canadian families trying to figure out who to actually call, to make sense of the mortgage side.
Yeah, that's the hard part.
So we've been looking into Moneris Financial Services as our kind of case study for how to navigate this.
Exactly, because as we're about to see, with the new stress tests and rate volatility, you really need a human being who can navigate all that. We'll get into the specifics, but if you're the type of person who wants to just execute on this, the contact is Mansour at Moneris.
Yeah, I've got the info right here. Mansour's direct line is 778-898-3202 or email mansour@muneris.com. We'll circle back to why a broker like that is so crucial, but first, we have to unpack this alphabet soup.
Uh-huh.
Because there's one account here that the research keeps calling the Holy Grail, the FHSA.
The First Home Savings Account, yeah.
Okay, be honest with me. When I first read the breakdown of this thing, I thought it was a typo in a government press release. It sounds way too good to be true.
It does feel that way, doesn't it?
Yeah. Usually CRA gets you on one end or the other.
Well, it's designed to combine the absolute best features of the two most popular registered accounts in Canada. You get the tax deduction of an RRSP.
Okay, so money in, you lower your taxable income,
Yeah,
you get a refund.
exactly. But you also get the tax-free withdrawal of a TFSA.
So tax break when I put it in,
Mm.
and zero tax when I pull it out to buy a house.
Bingo. And any growth, so if you invest that money and it doubles, that growth is completely tax-free too.
That is the Holy Grail part. But there are limits, obviously. They're not letting us just put $1 million in there.
No, the limits are strict. You get $8,000 in contribution room every year.
Yep.
And it caps out at a lifetime limit of $40,000.
$40,000 principal plus whatever growth you make.
Yep.
Okay, but here's the question, and I know this is the fear for a lot of people. What if I don't buy a house? What if I save for 5 years, the market goes nuts, and I decide, screw it, I'm renting forever?
Yeah.
Is that money trapped?
That's the beauty of it. It's not trapped. The account is valid for 15 years. If you don't buy a home, you can roll that money directly into your RRSP. And here's the aha moment that trips people up.
Okay.
It does not use up your existing RRSP contribution room.
Wait, explain that.
Usually you're limited by your RSP cap, right?
Yeah.
But an FHSA transfer is distinct. It effectively creates extra RRSP room for you, just out of thin air.
Okay, that is huge. So there is literally no downside to opening one if you qualify. Even if you never buy a house, you just trick the government into giving you more RRSP room.
Basically, yes. If you're eligible, then it means you're a resident, 18 to 71, and a first-time buyer. It is mathematically the first place you should put your down payment savings,
Okay.
before a TFSA, before a high-interest savings account, everything.
But the FHSA is the new kid on the block. We still have the old reliable, the RISP Home Buyers Plan, or HBP, but the sources say this has gotten a facelift recently, too.
It has. This is part of that 2026 toolkit we talked about. Back in April 2024, the government realized that, $35,000, which was the old limit, doesn't get you very far in Toronto or Vancouver anymore.
Not even close.
So they bumped the withdrawal limit up to $60,000.
60. So just to clarify, this is where I take money I already have in my retirement savings, and I kind of borrow it from myself to buy a house.
Correct. It's a tax-free loan to yourself. You withdraw it, no tax penalty. But unlike the FHSA, there is a catch.
Right, the catch.
You have to pay it back.
Okay.
The repayment clock.
Yes.
Yeah.
You have 15 years to pay it back into your RSP. The good news with the recent changes, though, is that the grace period before you have to start is now 5 years.
Oh, that's new.
It is. So if you pull the money out in 2026, you don't have to start repayments until 2031. It gives you some breathing room.
Okay, so we have the FHSA free money, essentially, and the HBP a loan from ourselves. Here's where it gets really interesting, Franny. The strategy isn't to pick one. It's to stack them.
Precisely. This is the stacking strategy. Let's just run a scenario. Say you have a couple looking to buy.
Okay.
They can both access the home buyer's plan. That's $60,000 each. So that's $120,000 right there.
Plus their FHSAs.
Exactly. If they've both been maxing those out for a few years, that could be another, what, $40,000 to $80,000 depending on growth?
Yeah.
Suddenly you're looking at a down payment of $200,000.
And why does that specific number, getting to that $200,000 range, matter so much in 2026? Because of the insurance rules. In Canada, if you have less than 20% down, you have to pay for mortgage default insurance, CMHC insurance.
Right.
But you can't even get that insurance on a home over a certain price. For a long time, that limit was $1 million. So if a house was $1.1 million, you had to have 20% down.
Which is over $200,000. So without stacking these accounts, a young couple basically had no way to get a family-sized home in a major city. They'd
Yep.
be stuck.
Exactly. Stacking is often the only way to breach that 20% threshold. Although we should note, the rules on that cap have also shifted.
Okay, but before we get to that, I want to clarify one thing about eligibility. Because first-time buyer sounds pretty definitive, but there's loophole, right?
The 4-year rule. This is crucial. It's for people who maybe went through a divorce or sold their place a while ago. You're considered a first-time buyer again if you haven't lived in a home that you or your spouse owned in the current year, plus the 4 preceding calendar years.
So let me get this straight. I owned a condo 5 years ago. I sold it. I've been renting for 4 full years. Boom, I'm a first-time buyer again.
Correct. And you unlock the FHSA, the HBP, all of it, all over again.
That is a massive detail. Okay, let's move to topic 2. The new rules of 2025 and 2026. You mentioned the price cap changing.
Yes. So as of December 15th, 2024, the government increased the price cap for insured mortgages up to $1.5 million.
Wow. Okay, so now you can put less than 20% down on a home up to $1.5 million.
Yes, there's a graduated scale for the down payment, but yes, it makes it possible to buy a $1.2 million home without having $240,000 in cash.
That helps with the down payment. But the bigger news for maybe not affordability, but for monthly payments seems to be the amortization change, the 30-year mortgage.
This is the big shift. Previously, if you had an insured mortgage, so less than 20% down, you were strictly capped at a 25-year amortization. Now, first-time buyers and anyone buying a new build can get a 30-year amortization.
Okay, let's play devil's advocate.
Yeah.
Because my dad would say, why would you want to pay for a house for 30 years? You end up paying way more interest. Why does adding 5 years matter so much?
And he's right. You do pay significantly more interest over the life of the loan. It's a double-edged sword. But the reason it matters is qualification.
Wow.
It lowers the monthly payment obligation, which helps you pass the stress test.
Got it. So when the bank calculates your debt service ratios, that lower monthly number is the difference between a yes and a no.
That's it, exactly.
It feels like a lot of these policies are just enabling us to take on more debt.
That is a very valid criticism. It kicks the can down the road. But for a family trying to get a roof over their heads today, that lower monthly payment is a lifeline.
Speaking of lifelines, let's talk about free money again. The GST rebate. What is Bill C-4?
This is a big one for anyone looking at new construction. Effective June 2025, there's a new rebate for first-time buyers on the GST.
And this is different from the old rebates. I remember those being pretty useless in big cities.
Very different. The old ones had price caps so low, like $450,000, that they were useless in Toronto or Vancouver. Bill C-4 targets the missing middle. It offers a rebate of up to $50,000 on GST for new homes priced between $750,000 and $1.5 million.
$50,000. That's a lot of cash back in your pocket.
It is. But remember, this is for new housing. It's designed to stimulate supply.
Right. And just to clear the deck, because I still see old articles about this floating around, the first-time home buyer incentive, the one where the government owned part of your house.
Dead. Gone. It was discontinued in March 2024. It was too complex. People hated it. Don't waste your time looking for it.
Good riddance, honestly. Okay, so we had the accounts, we have the new rules. Now we need to talk about the ally. How do we actually get the mortgage? Topic 3, broker versus bank.
This is the eternal debate. But in 2026, the data shows a clear shift. Brokers now handle about 43% of mortgage originations in Canada.
I like the analogy in the research. Going to a bank is like shopping at a brand store.
Right. If you walk into RBC, they can only sell you an RBC mortgage. It's like walking into a Nike store. They aren't going to tell you the Adidas shoe is a better fit
Or cheaper.
or cheaper. They sell Nike. A
Yeah.
broker is the department store or a personal shopper. They have access to over 50 lenders, the big banks, yes, but also credit unions, trust companies, monolien lenders.
But here's the thing that confuses people. The rate. I see a rate posted in the bank window. Is that the real rate?
Almost never. That's the posted rate. It's the sticker price on a car. No one should pay a sticker. Brokers get volume discounts. They send millions in business to a lender, so the lender gives them a better rate than you'd get just walking in.
So a broker could technically get me a better rate at my own bank than I could get myself.
Ironically, yes. It happens all the time.
Okay, now we have to talk about the controversy. We saw this all over Reddit. The fee. People are scared that brokers cost extra money.
This is a huge misconception, but there are red flags to watch for. The rule of thumb is this. If you have good credit and you're getting a standard A-lender mortgage,
Like from a big bank.
right, then the lender pays the broker a commission. You, the client, should pay zero.
Zero.
Zero. So if a broker asks you for an upfront fee for a standard mortgage and you have good credit,
That's a red flag.
massive red flag, walk away. Now, fees are normal for B lenders if you have bad credit or complex self-employment income, but for a standard family home purchase, it should be free to you.
And this brings us back to Muneris Financial Services. Because when we talk about navigating all this, finding the volume discounts, knowing which lender accepts the new 30-year amortization,
Yeah.
you need someone who knows the landscape.
Exactly. This is why we highlighted them. Mansour at Muneris specializes in the shopping around process for families. A lot of the anxiety in the market comes from rate volatility. A good broker isn't just finding a rate, they're managing the timeline.
Right. You want someone who's going to sit down and explain the strategy. So again, if you want to connect with Mansour at Muneris, the number is 778-898-3202. Or email mansour@muneris.com. You can also just check out the website, muneris.com.
It's worth a conversation, especially regarding the pre-approval process, which is our next topic.
Yes, topic 4, the process. Because a pre-approval is not what people think it is it?
No,
I think most people believe it's a guarantee. Like, I have the paper, I have the money.
not at all. A pre-approval is a rate hold. It just locks in an interest rate for, say, 90 to 120 days. But, and this is critical, it is not a guarantee the bank will lend you the money for a specific house.
Wait, really? So I can be pre-approved for $1 million, make an offer, and then the bank says no.
Yes, because the property itself has to qualify. If the appraisal comes in low, meaning you paid $1 million, but the bank thinks it's only worth $900,000, the lender can pull out.
That is terrifying.
It is.
Yeah.
That's why the condition of financing in your offer is so important. But in 2026, with rates all over the place, that rate hold aspect is your best friend.
Okay, practical tip time. The paperwork. The research says brokers ask for way more paper than banks. Why is that?
It can be annoying, but there's a good reason. If you bank with TD, TD can already see your paycheck and your spending. A broker is building your file from scratch to shop it to 50 lenders. They need the income confirmation, the down payment proof, the gift letters.
You mentioned gift letters. So if my parents help me out, I need something formal.
You do. It's for anti-money laundering laws. The bank needs a signed letter stating it is a true gift, not a loan that you have to pay back.
Why does that distinction matter?
Because if it's a loan, it affects your debt ratios. If it's a gift, it's just free and clear equity.
Ah, right. It all comes back to the debt ratios. One last practical tip. The 90-day rule for the RRSP.
Yes, strategic planning is required here. You cannot just dump money into your RRSP today to get the tax deduction and then pull it out tomorrow for the home buyer's plan. The funds need to be in the account for 90 days before withdrawal.
So if you're planning to buy in the spring, you need to be moving that money in the winter.
Precisely. If you miss that window, you can't use the HBP.
Okay, let's bring this all together. We've covered a lot. The FHSA, the HPP, 30-year mortgages, GST rebates. What does this all mean for the Canadian home buyer in 2026?
It means that the era of simple home buying is over. You can't just save cash and walk into a bank. It's about leverage. Leveraging the FHSA, leveraging the HBP, leveraging the new amortization rules to qualify.
And leveraging a professional to put it all together.
Exactly. Don't try to navigate Bill C-4 or B-lender fees alone. The system is too complex, and the stakes are just too high to guess.
So for everyone listening, check your FHSA room. Check your RRSP limits. If you need that ally, reach out to Muner's Financial Services. Mansour is at 778-898-3202 or Muneris.com. Don't leave money on the table because the paperwork is confusing.
And here's a final thought to chew on. We've talked about all these government programs, increasing caps, extending mortgages. It sounds great. But ask yourself, is the government actually making housing more affordable? Or are they just giving us new tools to take on more debt, which ultimately just keeps the prices high?
Oof. That is the real question, isn't it? Are we fixing the problem or feeding it? Something to think about while you're scrolling Zillow tonight at 2 a.m. Thanks for listening to The Deep Dive. We'll catch you next time.